Welcome to the Deep Dive. We're here to get you up to speed fast. And today we're jumping into Roku's Q3 2025 earnings call. Just happened on October 30th.
Yeah, and this one, it was a bit of a head scratcher, honestly. I mean, on the surface, the company did great. Really strong quarter. They hit this massive profitability goal everyone's been watching.
Okay, that sounds good. So what's the catch?
The market reaction. It was pretty brutal. After hours, the stock dropped, I think over 7% at one point.
Wow. So great results. Tanking stock. That's exactly the kind of puzzle we like to dig into here.
Right. Strong numbers behind them, but the market's looking ahead and, well, it doesn't seem to like what it sees.
Yeah.
So our job today is to figure out that disconnect.
All right, let's start with the good stuff then. What were the actual results for Q3 that looked so strong?
Okay, so the headlines were definitely positive. GAAP EPS, earnings per share, came in at $0.16. And that's huge compared to the consensus estimate, which was only $0.07. A big beat there.
Nice. And revenue?
Revenue was $1.211 billion. That was also a bit ahead of what people expected. And it represents 14% growth compared to last year.
But you mentioned profitability being the big story. That wasn't just the EPS beat, right?
Oh, exactly. This was the main event, really. They reported positive operating income, $9.5 million. Might not sound like a massive number, but it's the first time they've done that since way back in 2021. It proves the model can make money.
Okay, that's a significant milestone. And adjusted EBITDA.
Also strong, $116.9 million. So bottom line, financially, they crossed a really important threshold.
And what about people actually using Roku? Did engagement slow down?
Not at all. Actually, engagement was stellar. People streamed 36.5 billion hours in Q3. That's up 4.5 billion hours from last year. And the Roku Channel itself, still the #2 app by engagement time in the US.
So profitability's there, revenue beat, usage is high, all sounds fantastic.
Exactly. All the key metrics point to success for the quarter that just ended.
Okay, so let's tackle the elephant in the room. If Q3 was so good, why the sell-off? It has to be the forward guidance, the Q4 outlook.
Bingo. The market basically shrugged off the Q3 results and zoomed in on the forecast.
First, just remind us, where's the money really coming from? Platform or the devices?
Still very much platform. That's the ads, the subscriptions, content distribution. It was $1.065 billion, up 17% year over year. Devices revenue, selling actual streaming sticks and TVs, that was down 5% to $146 million. Lower margin business anyway, so that mix shift is actually good for profits.
Right, you want the higher margin platform revenue growing faster. But that growth rate, that's where the issue lies for Q4.
That's exactly it. Management guided Q4 total revenue to about $1.35 billion. That's like 12% year-over-year growth. But crucially, the platform revenue guidance implies only 15% year-over-year growth.
Okay, so Q3 platform grew 17%, but they're guiding Q4 platform to 15%. That's the deceleration the market seized on.
That's it. Investors saw that 2-point dip and hit the sell button. The worry is that the shaky macro environment, the ad market caution, is finally starting to really impact their growth engine.
But wait, there's nuance here, right? I remember reading the call notes. Didn't management offer some context on that 15% number, suggesting the core business isn't actually slowing?
They did, and this is absolutely critical if you're bullish on the stock. They pointed out that the headline 15% is being dragged down by a couple of specific things. One is the timing of political ad spending, which is always lumpy, and the other is the impact from their acquisition of Friendly TV.
Okay, so temporary factors or specific adjustments. What happens if you pull those out? What's the X items growth look like?
Well, that's the key point. If you adjust for those factors, management said the underlying growth is actually stepping up slightly. So Q3 platform growth, X items, was around 19%. The Q4 guidance, X items, implies something closer to 20%.
Hold on. So if you filter out the noise from politics and the acquisition, the core platform engine is actually accelerating from 19% in Q3 to maybe 20% in Q4.
That's precisely the message management wanted people to hear. The underlying demand, they say, is still very strong. But they're being cautious with the official headline number because, well, the overall ad market is still a bit uncertain. They don't want to overpromise.
Okay, that paints a very different picture. So the underlying health seems robust, potentially even accelerating. What about the financial foundation? Do they have the resources to back this confidence up?
Oh, yeah. Look, their balance sheet is solid. They've got $2.3 billion in cash and short-term investments. And their free cash flow over the last 12 months, $443 million. Strong cash generation.
And they put some of that cash to work recently.
They did. They bought back $500 billion worth of their own stock just last quarter. That's a pretty confident signal. And they stated their goal is to offset all share dilution over time through buybacks. That kind of financial firepower gives them options, lets them invest, even when facing giants like Amazon and Google.
Right, that stability is key. So let's shift to strategy. How are they planning to keep that platform growth going, especially that underlying acceleration? They mentioned 3 areas, right? Home screen, ad demand, subscriptions.
Correct. Let's start with ad demand. A big theme here is being open and interoperable.
Meaning not building a walled garden like some other platform.
Exactly. They want to make it easy for advertisers to buy Roku ads using the tools they already use and like. That means deeper integrations with third-party DSPs.
DSP, demand-side platform. Just quickly, that's the software advertisers use to buy ads automatically, right?
Yep, precisely. It lets brands manage their ad buys across lots of different websites and apps from one place. By integrating tightly with major DSPs, Roku makes its ad inventory super accessible to big spenders.
And the big integration they were excited about recently.
Amazon DSP. That integration just went live. This is potentially huge. It's similar to the success they've had integrating with the Trade Desk. Now, massive advertisers who spend fortunes through Amazon's ad platform can easily target Roku's audience too.
More demand, potentially higher ad prices for Roku. Makes sense. What's the other part of their ad strategy? Going after smaller businesses.
Yeah, the self-serve side. That's Ads Manager. This is aimed squarely at small and medium-sized businesses, and particularly performance marketers, the ones focused on driving immediate results like clicks or sales. Management sees this as a massive opportunity, like a multi-billion-dollar market on connected TV that's still largely untapped.
And are they getting traction there?
Seems like it. They mentioned that about 90% of the advertisers using Ads Manager in Q3 were totally new to Roku. So they're bringing fresh ad dollars onto the platform, not just shuffling existing budgets.
Okay, and how does technology like AI fit into making Ads Manager work better, especially for those smaller players?
They're leaning into generative AI pretty heavily here. The idea is to make it incredibly simple for, say, a local restaurant to create and run effective video ad campaigns. AI can help with targeting, optimizing the campaigns for better results, and even generating the ad creative itself, maybe with just a click.
Yep.
Their stated goal is to be the absolute most performant CTV platform out there, leveraging their scale and all that first-party viewer data they have.
There's a better ROI for advertisers, especially smaller ones. Got it. Now that ad engine needs a good user experience to keep people engaged. Which brings us to that big 2026 catalyst, the home screen overhaul. Sounds significant.
Oh, it definitely is.
Yeah.
They confirm they're actively testing a larger update to the whole user interface, the look and feel of the Roku home screen. This isn't just moving icons around. It sounds like a fundamental redesign. And the plan is to roll it out during 2026.
And the goal isn't just aesthetics, right? How does changing the UI help the business?
It's all about engagement and monetization. A better, easier to use interface keeps people happier, keeps them on the platform longer. More time spent means more opportunities to show ads. It also makes it easier for users to discover and sign up for premium subscriptions, whether it's Netflix or one of Roku's own services. The UI is like the storefront for everything they sell.
Let's touch on those subscriptions. Ads get most of the attention, but subscription revenue is growing too.
Growing very fast, actually, especially premium subscriptions where Roku takes a cut. Plus, they're launching their own services now, like Howdy, this $3 a month, ad-free service aimed at specific niches. It's a two-pronged approach. Facilitate third-party subs, and build their own targeted offerings.
And this all ties back to their forecast for ARPU, average revenue per user.
Exactly. They expect to hit 100 million streaming households globally in 2026. That's huge scale. But, crucially, they said they expect ARPU to grow faster than the number of accounts. All these initiatives, the Amazon DSP integration kicking in, Ads Manager scaling up, the new UI driving engagement, are designed to pump up that revenue per user. Okay, makes sense strategically. But let's zoom out again. What about the challenges? The macro environment, competition? What headwinds did they acknowledge?
They definitely acknowledge the cautious ad budgets. Competition is always fierce. They mentioned Fire TV, Chromecast, Apple TV specifically. It's a battle for eyeballs and distribution. They also noted that the big media and entertainment companies, the studios, are still being careful with spending, focusing more on profits than launching tons of new, expensive content.
Is that a major risk, the M&E slowdown?
Less so than it used to be, according to them. They stress they've diversified their advertiser base significantly. They're getting more money now from retail, healthcare, restaurants. so they're not as dependent on Hollywood ad budgets as they once were.
Okay, diversification helps. What about potential tailwinds, things that could help them despite the macro picture? Sports seems like a big one. Yeah, the fragmentation of sports rights is actually a massive opportunity for Roku, counterintuitively. Think about it. The NFL's on Amazon Prime one night, maybe Peacock another, ESPN Plus. It's getting complicated for fans just to find the game. If you follow baseball, your team might bounce between 3 or 4 different apps in a week.
It's a mess to navigate.
Exactly. And Roku's position is that their platform, specifically their Sport Zone feature, which aggregates games and scores, becomes essential for simplifying that mess. They want to be the starting point for watching sports. If they nail that simple user experience, it doesn't matter which streamer has the rights, users need Roku to make sense of it all. That's real leverage.
Interesting angle. Okay, one more potential tailwind, maybe more speculative, data monetization. All these AI models need training data. Roku has incredible data on what people watch. Are they thinking about selling access to that?
That question came up directly on the call. And yeah, the data, they have billions of hours of viewing, ad interactions, even purchase data. Sometimes it's gold for understanding consumer behavior. Management confirmed they are investigating licensing that data to LLMs or other partners. It's not the main focus right now. They primarily use it to improve their own ad targeting, but they see it as a potential new high-margin revenue stream down the line. Definitely one to watch.
Fascinating potential there. All right, that covers the results, the guidance, confusion, the strategy. Before we get to our final thoughts, time for the standard but very important reminder. We are not financial advisors. Everything we discuss here is purely for informational and entertainment purposes. Definitely not investment advice. Please do your own research.
Absolutely. Yeah. But if we were putting on our hypothetical hedge fund analyst hats for a moment.
Here we go.
Look, the pitch would leverage this exact disconnect we've been talking about. The market is hyper-focused on that Q4 guidance number, which, as we discussed, seems artificially low due to temporary factors and just general caution.
Right, ignoring the Q3 beat, the profitability milestone, the raised full-year outlook.
Exactly. And ignoring the very clear, confident roadmap for 2026, the new UI, Amazon DSP really kicking in, Ads Manager scaling up, if you actually believe management can deliver on that plan.
Then this short-term dip looks like an entry point?
Potentially. So the speculative trade idea isn't about timing the next quarter. It's about betting on that 2026 execution.
How would you structure that bet?
You'd look at buying long-dated call options, maybe 18 months, even 2 years out, go out of the money. This lets you bypass the near-term choppiness from the ad market uncertainty over the next, say, 6 months. You're essentially making a leverage bet that management delivers on the big platform catalysts in 2026, driving that high-margin ARPU growth they're forecasting. It's purely a bet on their strategic execution.
A leveraged bet on the 2026 story, ignoring the Q4 noise. Interesting. Okay, so let's wrap this up. The key takeaway for you listening. Roku delivered on the fundamentals in Q3 profitability, solid growth, but the market got hung up on the slightly slower Q4 guidance.
Yep. So the whole story now boils down to execution. Can they deliver that new home screen, make the big DSP partnerships work, and turn Ads Manager into a real performance marketing engine?
If they pull that off, the path to sustained profitable growth looks much clearer.
That's the bet.
And the final thought to leave you with, building on that sports discussion. If sports does continue to splinter across countless streaming apps, does Roku's role as the simple aggregator, the easy way to find your game via the Sports Zone, make it almost indispensable for sports fans?
Could that simplicity give them lasting power, almost like a utility, no matter which media giant wins the content wars?
Something to think about. That operational leverage could be very powerful indeed.
Definitely.
All right, that's our deep dive on Roku's Q3. Thanks for tuning in. We'll catch you on the next one.